So let me bring to the show very quickly Phillip Streible, Senior Market Analyst, Blue Line Futures. Phillip, good morning and thank you so much for joining us.
Yeah, thanks for having me.
So Phil, we're going to kick off with the Fed, of course, and then we're going to move to the energy market. By the way, they're pretty connected since, of course, we did see once again that the energy prices are once again a major contributor to the inflationary pressure. So let's just kick off very quickly with what are your expectations from this Wednesday evening? And of course, what would you like to hear from the Fed, since this is probably going to be the first more hawkish tone of the central bank?
This will be the peak on hawkishness for the Fed, and also they will acknowledge, the recent economic data that's been so strong. They're going to acknowledge the overheated inflation, and they're going to want to combat that immediately. The problem is that going forward, that growth is going to slow, and also inflation is going to slow. So they're going to be tightening into a slower economic environment, and that's why you're seeing that reaction on U.S. equities. I really think that we might have seen the peak on equities as well.
All right, so the record highs are over and Christmas rally came earlier?
That's the way it is. So now what happens is that fund managers that are trying to protect performance are going to run for the doors. They're going to try and exit as fast as possible to lock in the gains that they had on the year. It was a spectacular year for U.S. equities. I mean, we've been up, over 20-something% throughout most of the year. And when you start to see these quick sell-offs in, other asset classes, everything with cryptocurrencies, energies, metals, all trending lower into the end of the year, you're going to want to exit quickly.
We're going to touch on cryptocurrencies because you mentioned them, and there is very interesting correlation between the cryptocurrencies performance and the rest of the asset classes. How do you explain that, and is it weird for you?
Well, it was the cryptocurrencies. They were kind of the driver. It seems like many individuals were, living off of the rally that they had in the cryptocurrencies. Now that those are breaking down and the trend signals are breaking to bearish trends, we could see a quick sell-off on cryptocurrencies.
This is pretty interesting, and very quick check, of course, on energy prices, major contributor to this inflation pressures to the upside, specifically here in Europe. We saw the IEA report today. Demand for oil is said to be lower than expected next year, according to the IEA. Not only it said that global oil demand was now expected to rise by 5.4 million barrels per day in 2021 and 3.3 million barrels per day in 2022 to hit pre-pandemic levels of 99.5 million barrels per day globally. So this is not a beautiful report in terms of demand, that's for sure, and for obvious reasons. We're talking about Omicron. Are we going to stick to these price ranges, $65 to $75 per barrel, in your opinion?
Yeah, I think so, for at least the time being. I don't see oil getting back over $80 anytime soon. The problem is that you just have an administration that's really against those higher prices. You've got OPEC is still compliant. They're trying to pump more despite any kind of capacity issues actually getting the oil out. And many countries out there are continuing lockdowns and really tightening up their borders and their policies. So oil prices, I don't see them really breaking out too much. And actually, we put some bearish positions on oil here this morning.
So do you think what President Biden promised that you're gonna see, to be honest, lower energy prices is actually going to realize?
He got real lucky with that with this new COVID variant coming out, because you saw the day that it released from the SPR, we saw oil prices capitulate higher. So it was just sheer luck and coincidence that this new variant corresponded with lower oil prices.
Final take on the gold. It's off about 1% today at $1,767 an ounce. Is it still a hedge, inflationary hedge?
It only works as a good inflationary hedge when you have declining growth. So I think that gold's downside is limited, and we'll start to trend back up from here. 1,800 by the end of the year, I think, would be a bit of a stretch, but it is possible.
So the 2,000 mark, the 2,000 target, which was the target of many analysts, is not a plausible thing until the end of the year.
No, not at all. I mean, the only thing that could get it going again is if the Fed strategy completely backfires, where they want to raise rates and everything else, and the market's crashing and they got to pause it. That would be the only thing that could save them, because they're not going to do any more stimulus measures. So if you're going to have to look at, if you're bullish on gold, you're going to have to look at like buying gold, shorting euro currency, shorting British pound against it, something else, taking gold in different terms and those charts probably look a lot better.
Thank you very much. Phillip Streible, Senior Market Analyst, Blue Line Futures. Thank you so much for joining us, and of course, have a great day ahead.
Thank you. Take care.